Hello, I'm Kristen King from the Investing Channel, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. So far this year, there is one asset that has been largely ignored, simply because it is so boring. That's the US dollar. Compared to the Bitcoin, movements in the dollar are minuscule, but this has not always been the case. In the second half of 2020, the dollar sank like a stone. The weight of the $3 trillion quantitative easing and the $100 billion plus monthly bond purchases increased the dollar supply tremendously. Take this statistic. 22% of all US dollars ever created happened in 2020. When the supply of an asset is near unlimited, nobody wants to hold it. Major holders of the currencies, such as large corporations, traded away for other assets quickly. Investors bought stocks, they bought property, some bought commodities, a lot bought into the crypto asset Bitcoin, which has a limited supply of 21 million. This year, however, is seeing a change in the dollar. It is no longer falling as fast as before. This is strange. The Fed is turning on the monetary tap like never before, yet the currency has remained more or less steady. Is it possible that the dollar is poised for a downtrend reversal? If yes, is there a trade in there? Look at the US dollar index. This index is one of the benchmark indices to gauge the value of the US dollar. 6 major currency pairs drive the index, including the euro dollar, sterling dollar, and dollar Japanese yen. This index has declined from its March peak at 103 to a low of 89 earlier this year. Since then, the index has bounced up to near 92. Chart-wise, the index is forming what is known as a small base. If we look back to the history of the dollar against that of stock markets, typically investors buy the dollar when stocks are falling. A good example of this inverse relationship was seen in March last year. Now, there is no such fear at this point. On the contrary, market sentiment has swung decisively to the other side, namely greed. The dollar has remained steady while stock markets are running hot, perhaps too hot. Based on past market relationships, many are wondering if the dollar's strength suggests a weaker stock market in the weeks ahead. Yes and no. Whenever the market corrects, the dollar goes up. This is a time-tested relationship. A stronger dollar is often associated with a weaker stock market. But the key issue is this. The firm dollar is probably not the catalyst that will cause the market to correct. That catalyst is somewhere else. For example, in March last year, it was the pandemic that caused a market panic. As a result, stocks slumped and the dollar appreciated. So what will be the catalyst this time? The only one that we can see on the horizon is a sharp rise in interest rates. Have you seen what is happening in the U.S. Treasury market? The U.S. 10-year bond yield is now trading in excess of 1.3%. The cost of borrowing has increased by more than 80 basis points since last summer. A quick check at some Treasury ETFs, like the iShares Long Treasury ETF with ticker TLT, shows a steepening negative price trend. Looking at Trackstar IQ, our proprietary search tracking tool, 26 institutional investors have researched TLT over the past few weeks, which suggests we're not the only people thinking this way. In January, we talked about shorting treasuries when the yield just broke north of 1%. This trade has worked better than expected. Traders are dumping treasuries now because they fear inflation will rise further this year. A spike in interest rate would cause the stock market to wobble because it raises the cost of borrowing. A weaker stock market will, in turn, be accompanied by a rise in the dollar as investors seek safe haven assets. But bond bulls will say that this rise in interest rates is a reflection of a normalizing economy plus a synchronized global recovery. And following an aggressive vaccination program, some economies are gearing up for a major reopening in the summer. Some even assumed that a 3% 10-year Treasury yield, more than double the current level, is appropriate given the potential economic expansion. Moreover, the Fed can always implement yield curve control to limit the rise of the long-term Treasury yields. So the question is, should we buy the dollar in anticipation of a market correction? Perhaps, but this is no more than a short-term trade. The Fed is still buying vast quantities of bonds every month, and if the market slumps as a result of a rise in interest rates, the central bank will probably buy even more bonds and cause the dollar to weaken again. That's all we have time for this week. Remember, make sure you do your own due diligence before making any investment decisions. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.